Hello everyone, welcome to Master's Teach, and today we'll discuss about the investment and portfolio management. So as it is fourth sem, it is going to have part of theory as well as problem solving. So I'm going to deal with the theory part. Okay, we'll discuss about the portfolio theory, analysis, selection, CAPM and APT and performance evaluation. Okay, so try to, those who are not prepared for the calculations or financial matters accounting, just listen the class, at least fill the your exam. Okay, so that you're going to have good marks. We have 5 units in this. We'll check about the portfolio theory. What is portfolio? It is nothing but people are invests in the financial assets like fixed deposits and equities, that is share market, bonds, that may be government bonds, and money markets instrument, okay, which is held by the investor. Okay, you might be aware, those who are doing in stock market, for them it is easy to understand. So risk return relationship. So you invest in stock market or in bond or in real estate. So there is a risk. Okay, so the portfolio aim is that you are going to balance the risk and return balance. Okay, there is more risk, more return, less risk, less return. Okay, what is diversification? So you, for example, you have 1 lakh rupees. You should not put all the things in share market. However, you have to divide that 1 lakh in different investment instruments, like put 20% in stock market, 20% in fixed deposit, 20% in gold, 20% in real estate. Okay, like that you have to diversify. So here the statement, here you check here, diversification means spreading investment across assets, reduce the risk. If you invest the amount in different sectors, the risk will be less. So don't put all the eggs in one basket. That's the concept. Try to write this first so that you're going to have marks. Okay, then basics principles of theory. Okay, risk return trade-off. That means, so if you want to have quick returns, there is a risk also. Those who are doing intraday trading, so the risk is more, the return is also more. Those who are doing options, the risk is more, the return is also more. Diversification. Okay, so if you are diversify means putting the amount in different assets, okay, which gives the like less risk. Correlation. So lower correlation among the securities, greater diversification assets. So there is a correlation investments. Then asset allocation. So whatever the amount is there, you have to allocate according to the your goals. Okay, that is the thing. Okay, so process of portfolio management. As a manager, people give the money, you have to invest in different sectors. So how you have to process that portfolio management? Identify the needs. Okay, you have to identify the investor needs, whether he want to have quick returns, whether he want to have regular income, whether he want to have easy cash. Okay, and the aim is also like they want to have longer investment or short term investment or medium term investment, that you have to think. Okay, set objectives. So what the like return, whether how much they want to have return. Okay, is it 20%, 30%, 5%? Okay, that you have to according to that you have to set the objective. Formulate formula. So you have to make some formula for investment. Okay, then construct monitor. So once you build the portfolio, then you have to monitor that portfolio, so whether how it is performing or not. So try to write this. Okay, try to write this about the concept of portfolio, what is portfolio, risk return relationship, diversification. Okay, then basic principles, remember this: risk return trade-off, diversification, correlation, asset allocation. Then process of portfolio management: identify the needs, set the objectives, formulate the formula, construct and monitor the same. Then portfolio objectives. Okay, the objectives are capital appreciation, regular income, capital preserve, liquidity, tax efficiency. People or invest their money for the capital appreciation. That means they invest the money, and certain period of time they want to double that money, they want to increase that money. Okay, that is called capital appreciation. Then regular income, those who are like get the lump sum amount for insurance they got. Okay, what that is, they invest in the fixed deposit, and every month they are going to have, that is the thing. Okay, and you can prefer these mutual funds. Okay, some give end of the tenure, some give monthly also. Capital preservation, what means, so whatever happen, whatever the investment is there, that need to be saved, fixed deposit. Okay, that is the thing. Liquidity, liquidity means whenever they want to have the money, okay, they should have that thing when they invested. Then tax efficiency, some people earn the money legally or illegally, so they want to save the tax. That is the reason they are going to invest in bonds, tax free bonds. So when they ask in the examination what is portfolio objectives, you have to mention capital appreciation, regular income, capital preservation, liquidity and tax efficiency. Okay, then portfolio constraint, risk tolerance, whether able to have the risk even if the money goes out, and time horizon, what time, how much time they want to investment. Liquidity needs, for example, people save the money and invest the money for the future purpose, for the emergency purpose, for the marriage purpose. Okay, so that you have to. Legal regulatory constraints, so if you investment, then some legal things are there. Tax consideration, so some people invest in order to save the money, that you have to consider. Unique investor circumstances, some people have different aims in investment. So these are the things, these are the objective, these are the constraints. So the investment policy statement, IPS, formally document objectives and consent, guide all the portfolio decisions. So whatever these objectives, whatever the constraints, whatever the guiding thing, that is called as investment policy statement, IPS. Okay, try to write this where you can have good marks. Then traditional versus modern portfolio theory. So how the traditionally previous our fathers, forefathers, how they invested, and now the portfolio, how it is there. Okay, focus, like previously it was individual security. Okay, nowadays the portfolio as a whole. So previously they used to invest only in stock or in real estate or in the fixed deposit. Nowadays people are investing in gold, in stock market, in fixed deposit, in real estate. Okay, so it's a portfolio nowadays as a whole. Method, qualitative, they used to have qualitative, good returns, security, that was there. Nowadays quantitative analysis, that means, so they put more things, okay, in a portfolio and they will analyze. The risk is previously limited risk. Okay, if they input the amount in the fixed deposit, there is no risk. Okay, so the measuring was very simple. Whereas variance and covariance, that means it changes, risk changes as per the time. Approach, so traditionally they want to save the money, now it is optimization, that means sometimes may risk, sometimes may lose the money, sometimes they gain the money. So Harry Markowitz, Treynor, MPT, that is a modern portfolio theory. Who introduced? Harry Markowitz. Okay, introduced the mean variance framework for the optimal portfolio construction. So this person is given the about the model of MPT, that is a modern portfolio theory. Okay, try to remember, try to write, try to fill the examination thing, so that which will give good marks, at least you are going to pass. It is not for the expert people, for those who are working, and for them to get the good marks. Okay, traditional portfolio analysis and diversification. Okay, traditional portfolio analysis, how it is done previously. Okay, adding securities randomly, reduce risk but with the diminishing returns. Okay, previously they are very choosy, and so that the risk is very less, but with the diminishing return. Initially it starts growing, the investment return, then it becomes stagnant, then it is diminishing. Okay, those who have already studied their become, they know this. Then Markowitz diversification. Okay, already we said this. Harry Markowitz, what he told about the modern portfolio theory. So select the securities based on uh, covariance and correlation, not just number of securities. So there are many things when you are selecting the different types of securities. That time we use covariance and correlation. Key insight: number of security alert is not sufficient. The co-movement between them matters the most. Okay, how many number of shares you have, it is not matter. How many number of things in portfolio, it doesn't matter, but it is the co-movement, each should movement accordingly. That is the main motto. Okay, so this is about the theoretical part. Okay, then effects of combining securities, just positive correlation. Okay, try to write this diagram. Okay, positive correlation. Okay, it is no diversification, benefit risk added up. Okay, what happened, only they adding the thing. Okay, no diversification. For example, if you invest in Tata Steel, you are going to invest the same entire year or entire years. Okay, the positive correlation, zero correlation. So moderate diversification. So you invest in Tata, you invest in Adani, you invest in Reliance. Okay, moderate. Then negative correlation. Okay, like maximum diversification benefit, risk cancels out. If you maximize different types of investment is there, sometimes which may give negative correlation. Correlation positive correlations, this is the formula, no diversification benefit, zero correlation moderate, and negative correlation which gives the maximum benefit. Lower correlation is generally greater diversification benefit reduce, and portfolio risk. So this is the suitable one, zero correlation, where it gives the moderate, not too much profit, not too much loss. This you have to remember. Okay, then we'll check the next. Okay, it's effects of combining securities. Then go to this portfolio return. This is a formula. Okay, so E into RP equal to summation of WI into ERI. So where WI is the weight of security, ER1 is expected return of security I. So remember this formula, work formula, security A like weight 60, return 12%, security B 40%, return 8%. So this is a R and P form. Okay, this is the thing, how much they are going to have, 10%. Just see, my my specialization is not finance. Okay, just in order to get pass in your exam. There is a motto of making this video. Okay, these are the portfolio risk, minimum variance. Okay, try to write these, take the screenshot. Okay, when you are traveling, listen the same, watch the same, try to take the notes. Okay, so minimum variance portfolio, the portfolio combining that yields lowest possible risk for a given set of securities achieved by selecting optimal weights. Okay, so portfolio beta concept measurement. Okay, so these are the things. Okay, uh, beta less 0 inverse movement, beta equal to 0 risk free, beta equal 1 moves with the market, beta greater than 1 aggressive high sensitive, beta less than 1 but positive defense and low security. What is beta? It is a beta is a security, measures a security sensitivity to market movement. It quantifies systematic, that is non-diversified risk. The portfolio beta formula is this the thing. Okay, try to write this, at least you're going to succeed in your exam. That is the main motto of making this one. Okay, portfolio selection, investor preference. So average, risk averse. Okay, risk neutral, risk seeking. Okay, so this you have to remember. Portfolio selection, investor preference. So different investors have different attitude. Types of investor, when they ask the question, you have to write risk averse, risk neutral, risk seeking. Risk averse means prefer less risk for same return. Risk neutral means indifferent to risk level. Risk seeking means prefer to higher risk to for thrill. So optimal portfolio where the highest attainable indifference curve and intangent to efficient front end. Just remember these three things and write blah blah. Okay, so Markowitz and shape and traditional portfolio selection. So aspect risk measure. So traditional is the qualitative, whereas Markowitz is the variance and covariance. Sharpe is the beta B. Okay, diversification intuitive, whereas they think it is going to be happen, whereas Markowitz is a correlated based and Sharpe is a systematic risk. Complex, it is a traditional is a low risk, whereas Markowitz is a high and shape is a reduce. So this is the thing. Beta's role in Shape's model, beta determines the security contribution to portfolio systematic risk, the key input portfolio selection and exam problem. Okay, so this is a capital market theory and CAPM capital market theory. What is the formula? This is the formula. You have to risk CML, risk return line for coefficient portfolio. Okay, this is the thing. SML, risk return line for all securities. Okay, so this you have to remember. Try to make this one. Okay, at least you will get the past. Okay, then arbitrage pricing theory. Arbitrage means future, what is going to be happen. So this is a capital market theory. Okay, it is a APT. Okay, so factors, single market, multi-factors, market portfolio required, not required, basis, equilibrium, arbitrage. Okay, this is the thing. APT is based on law of one price. Identical asset must have the same price. Arbitrage portfolio exploit mispricing. Okay, portfolio performance evaluation. This is a formula you have to remember. Okay, then this is the thing. This is a small presentation for so that you can pass. Okay, thank you for watching Masters Teach. We'll meet with the next lecture.